The next concept that I'm training on is the explanation of the money on money multiple. The money on money multiple is the same thing as the multiple of invested capital, which measures how much total value an investor receives relative to the amount of capital that they originally invested. It is a simple measure of absolute return without accounting for time or compounding rates. The money on money multiple equals the total cash received, including the exit proceeds and dividends, over the total equity invested. So a good example of this is, let's say you're a private equity fund and you've invested $100 million into one company. After 5 years, you sell it and receive $300 million in total proceeds, including the dividends. That would mean that your money on money multiple would be 300 over 100, which would be 3x. So as an investor, you've earned 3 times your money, or a 3 times money on money multiple on that investment. If your money on money multiple is greater than 1, that's a positive return, right? You get back more than you've invested. If your money on money multiple is 1 exactly, that means you break even. And if your money on money multiple is less than 1, that means that you have a loss. Essentially, you got back less than you invested. It's an absolute measure, right? It doesn't really consider when the investor received their returns. That's why private equity firms and investment banks use the internal rate of return, or IRR, with it, because the IRR tells you how quickly you earned those returns, while the money on money multiple tells you how much you earned in total. This is important to understand the relationship between money on money multiple and the internal rate of return. The money on money multiple shows total return, while the internal rate of return adjusts that multiple across the return of time. So for example, a 2x return in 3 years is about a 26% internal rate of return, but the 2x in 7 years is only a 10% internal rate of return. So money on money ignores time value, but the IRR incorporates it. In banking, when bankers are building LBO models, the money on money multiple provides a quick sense of total value creation, so how many times they've made their money back, whereas the internal rate of return provides an annualized measure used to compare investments of different lengths. The rule of thumb for PEs is that for the PE firms is that in a 3-year time horizon, you're targeting anywhere between a 25 to 30% IRR, and then approximately a 2 to 2.5% money on money. At 5 years, you're looking at 20 to 25%, with the approximate money on money from 2.5 to 3. And then across 7 years, you're looking at a target IRR of 15 to 20%, and an approximate money on money multiple of 2.5 to 3 times. So essentially, right, I think that is important for top to bottom to understand how the money on money multiple, or MOIC, is related to IRR. The money on money multiple measures the total return relative to the amount invested. It's calculated as a total cash received dividend by total equity invested. For example, if we invest $100 million and sell the company for $300 million, like I said earlier, that's a 3x money on money multiple return. And it's just a simple absolute measure, right? It tells you how much of the value you made, whereas the internal rate of return tells you how quickly you made it and factors in the time horizon and the time value. Thank you.